Before we get into the episode, a quick reminder that the last trade is for informational and entertainment purposes only, and nothing should be construed as investment or legal advice. Now for a word from Onramp. Onramp is a Bitcoin asset management platform built on multi-institution custody. We serve high net worth individuals, institutional investors, and financial intermediaries with a best-in-class suite of products, which include multi-institution custody, a spot Bitcoin fund, Onramp Wealth for RIAs, and private wealth services for high net worth individuals. Leveraging our partnership with BitGo and other industry leaders, Onramp's multi-institution custody is a first-of-its-kind institutional-grade vault, requiring 2 of 3 institutions at any point in time to sign once a client's unique permissions have been met. Our multi-institution vaults utilize cold storage, key signing, and authentication at the direction of the client to maximize security for client assets. This pioneering approach to custody is the foundation of Onramp's financial products, which reduce counterparty risk associated with trusting a single institution. To learn more about how Onramp can help you secure a new or existing Bitcoin position, please visit our website at onrampbitcoin.com, where you can schedule a consultation and connect directly with our team.
What you're telling me is that music is about to stop, and we're going to be left holding the biggest bag of odorous excrement ever assembled in the history of capitalism. 1974, 1987, 92, 97, 2000, and whatever we want to call this. It's all just the same thing over and over. We can't help ourselves.
I say when we sell. Hey, I say when we sell.
We're making fun of my fat face. Welcome back to the last trade.
It's a good way to start any episode.
This is the life of a road dog. Cam and I were road dogging it this week up to Fort Worth for the North American Blockchain Summit.
How was it, guys? Yeah.
It was good. It was productive. It was a productive 2 days.
Cam, you might be on mute there.
I'm not. Can you hear me?
Yeah,
you're good.
Gotcha. Yeah, great production quality by Lee and team, but it also is very indicative of 2 years almost into a bear market where it's not a whole lot of new market participants yet. You know, it's mostly all the friends, the industry operators that we know.
So a bunch of familiar faces, and everybody's been heads down building the infrastructure for the next bull market, huh?
That's right.
I think that's been the entire conferencing the past year, at least, right? Which is, I'm not complaining, kind of solidifying those ties with some close friends, getting ready for the next run here.
Yeah. No, I mean, Jesse, to your point, I don't know if you were saying that facetiously, but it is interesting to catch up with people who have been building in the bear market, particularly in the mining industry. I think there's a lot of really strong building going on right now. Mining, obviously. This is probably the worst bear market cycle in the mining industry historically. I don't know if we've ever touched on this on the last trade, but I think it is important for people to learn the lessons that the mining industry learned over the last 2 years. So last cycle, 2021, bull market, a lot of miners aped into ASIC collateralized debt around the all-time high of ASIC pricing. Not only that, they engaged in futures orders on machines that weren't delivered for more than a year. And so they put a lot of capital down for goods that would not be delivered for a year. When they were delivered, they were worth significantly less than when the order was originally put in. So a lot of miners got wrecked when the price of Bitcoin fell over the course of 2022. And we've had a lot of consolidation, a lot of sort of overgrowth washed out of the industry. We've hit this bottom. Hash price bottomed out around 5.5 cents, 6 cents, and people learned a lot of lessons and are building what I would deem to be more structural, more fundamental base layer with structural integrity at the industry base. People are really wise about how they approach debt, how they lock down their energy, where they do that. It's a long monologue. But I talked to a lot of miners the last 2 days. There's a lot of good stuff going on. Cam, I don't know if you saw that as well.
Yeah, I sure have. And that's, for me, been one of the most enjoyable parts about being in Texas is so much of the mining industry is here. And that, really had the opportunity to talk with so many miners, learn about so many different types of business models at all scales. But 2022 was probably the toughest year for miners, would you say, Mark? I know the 2018-19 bear market was difficult as well, but you had converging dynamics of not only a price drawdown of about 80%, which is typical for Bitcoin after the 4-year halving cycle, but then you had energy costs rising, and then you had hash rate, which continued to scream up and to the right and continued to hit new all-time highs. And I think we've got some pretty good suppositions as to why that might happen, but that is truly a worst case scenario that is hard to model and plan for. And then on top of that, as you mentioned, some of the loans. And I also get the sense too, talking with firms like EDG and Luxor, that the market is still nascent in some respects towards treasury management and considering options and hedging, and just planning for and having the tools to plan for some of those worst case environments that you have to operate in for an extended period of time.
Yeah, this is a good opportunity. We're going to start with mining on this episode.
Yeah.
We've got Andy Thompson with us from BTC Talent Co, Cam Stromey from Onramp. If you're hearing the intro to this podcast, that's Cam's beautiful voice. I'm sure you recognize it. We are going to talk about a lot about business formation because of what Andy's seeing at BTC Talent Co at the intersection of all the companies looking to hire the best talent in the world, which I think is really insightful for this particular point of the cycle. But zooming into mining, just because it's fresh on our mind, because we were just with a bunch of miners in Fort Worth, I don't think we've ever really done a deep dive into the mining landscape, particularly the economics around it on the last trade. It's a good opportunity to do that. So Logan, if you want to pull up insights.brains.com, this is a great resource for anybody out there trying to understand what's going on in the mining world. Logan, go out to the 3-year view. Let's just look at the last 3 years. So what we're looking at now is a chart that has price overlaid with hash rate and difficulty. And as you can see, in late 2021, we peaked at price and started going down. But despite that, hash rate has, where are we at now? Where are we at? I'm going to pull it up on my screen so I can see. Hash rate is more than doubled. It's gone from 164 exahash at the all-time high, and now it's sitting at 455 exahash a second, which is pretty insane growth throughout the bear market.
Does this go back to, can we see like the prior bear market? Because I vaguely recall the hash rate quadrupling during, like, from the bottom in 2019 until the halving. That's my vague recollection. So is this just something that happens where the hash rate catches up when, catches up to where it couldn't get to quick enough during the bull market, and then the growth continues, in the lulls post from the bottom until the next halving?
Yes. So like in the middle of the bull market, economics are really good. People are really bullish. They have a lot of cash on their balance sheets. Like I mentioned, in 2021, a bunch of people engaged in futures orders for the Bitmain S19 series and the MicroBT M30, M50 series. And so they put these orders in at the height of the bull market, and then they eventually do get those ASICs delivered, or the ASICs do come to market in some capacity. And if you buy them, you got to plug them in. You can't just have them sitting on the sidelines. And so that is probably what's driving this growth, is just that lag of inventory being delivered to market and then eventually being plugged in. And then on top of that, I don't think it's well known, but outside of the industry, but what Bitmain particularly does, MicroBT might engage in this as well, is if they have a bunch of inventory that they're sitting on and they can't move it, they want to make revenue. So they'll often plug those machines in They'll find somewhere to host the machines, and they'll plug them in and make revenue on them before they find a buyer to offload those ASICs on, so that they can monetize that inventory while it's sitting there.
I've also been curious before of what's the miner mentality right now. We've got 5 months until the halving. Is the mentality like plug everything you can in right now and get it while the getting's good, because block subsidy drops in half in 5 months. So right now is actually kind of like a golden time to be mining relative to the entire future of Bitcoin mining.
Certainly it's that. It's also like, how are we locking in the lowest price possible to ensure that we can survive after the halving, particularly if you're running a fleet of older generation miners. So once that halving comes and that subsidy gets cut in half, and if the price doesn't appreciate materially between now and then, your revenue is going to be significantly hindered, and that hash price is going to fall significantly. And I think we can pull that chart up too on Insights, just to understand what miners are looking at, what metrics they're following to determine hash price. You can go to the 3-year view because it's a little expanded, but like over the last 3 years, you can see hash price, which is the blue line on the screen if you're watching it, which essentially just looks at the dollar per terahash per day that's produced by the miner. That bottomed out around 5.5 cents in November of last year when we had that big price fall. Now it's currently sitting at 9 cents. So it's almost double where it was this time last year. And that's partly being driven to the price appreciating. But if you go to transaction fees, Logan, one thing that's also happening that's interesting in the mining world that's really driving significant revenue is the fees of the Bitcoin network have gone up as this ordinals craze has gone off. People are issuing essentially digital assets on top of Bitcoin using ordinals or the BRC20 protocol, which is computationally expensive. It takes a lot of data, and the way block space works, the more data you have in a transaction, the more expensive it's going to be. And so this ordinals craze has really driven transaction fees. Right now, they're making up 20% of the overall block reward, which is pretty significant.
And there were a few blocks in May where fees were more than the block subsidy, which I guess had actually happened a few times before in Bitcoin's history, but those were kind of flukes. And this was, it's an unusual reason, ordinals driving high fees. But Marty, I had a question on the hash price chart. So, at what point does the S9 just not make any sense ever? And obviously it's based on what energy price you're getting, but for most miners.
So we can actually pull up Insights again, Logan, and scroll down a little bit. And they actually have a good calculator here. So right now, if we see this, the Bitmain S9, which is considered the AK-47 of the mining industry, it launched in 2015. The first batch of them did. They really hit the scene in 2016. So they've been around for almost 8 years now, 7-8 years about. And right now, so if you can see this profitability of the different ASIC models, right now, if your electricity cost is 6 cents, you are unprofitable. But if you change that, let's drop it down to 2 cents. The S9 becomes somewhat profitable. So right now, if you're running S9s, your all-in electricity cost probably has to be below 4 cents, I would imagine. And then after the halving, if the price doesn't appreciate materially, you're probably going to be unprofitable. Difficulty is obviously going to go up. Bitmain and MicroBT have both announced that they're going to have very efficient and high hashing machines hitting the market in the beginning of next year. So that should add a material bump to hash rate. And another interesting thing there as well is that Bitmain, with their S21 series, they really shocked the market a few months ago when they announced the pricing for those ASICs at $14 a terahash, which is actually below the market rate of the S19 XPs, which are the highest hashing machines on the market right now. So Bitmain has come in with a very aggressive pricing strategy for their top of the line models, which are going to be way more efficient than the S19 XPs, which is leading people to believe that Bitmain's attempting to use their economies of scale on the production side to really begin to muscle out MicroBT, muscle out the competition. So that's one theory, or another theory is that we're getting close to the point of ASIC commodification, where they're just going to be bountiful and relatively cheap.
What a brutal industry. It's unreal. It's also just so deep. I've been full time on Bitcoin for years, and at no point have I really dug in to try to learn the mining industry, because my job depends on it. So I haven't really sunk my teeth into it that much, but I've been around paying attention and learning about Bitcoin for years, and I feel like I barely know. It's a whole deep industry that is that's incredibly brutal from an economics point of view, because there's not many industries that disincentivize being a long-standing player. In mining, there's actually an advantage to being brand new, because you get the most efficient machines. You can choose your machines based on what makes the most sense for the market at that point in time. But if you've been around for even a year, you're using machines that may become dated versus the market conditions and what you need to compete against. Absolutely brutal.
I was joking with some miners last night and saying, you guys are masochists. Why have you entered this market? And the nicer way to say that, which I did, was that you have sought out one of the most difficult problems to solve and one of the most difficult markets to compete in, period. But I think also in Bitcoin, that the execution risk. And then you talk to some miners that are taking that to the extreme, and two of them I talked to last night have set up a 1 megawatt operation in Costa Rica and are mining off hydro. And there are others so not only dealing with the operational and execution risk, but then you're working through the completely foreign regulatory landscape just to set up the operations. So this is what I've always thought too. We're curious to hear you guys' thoughts. Miners are probably the most bullish market participants, and because they're taking a look at, again, this industry where the halving is every 4 years. Definitionally, the nominal amount of Bitcoin they're earning is going to be cut in half on a predictable basis, and they're deploying millions of dollars of capex in advance, knowing that is the dynamic. You'd almost think if you're coming into this industry, that looking at the supply curve, that the hash rate would decline, either remain flat or actually decline over time because the opportunity decreases. But we've seen quite the opposite.
You're diving headfirst into the unknown every cycle, once every 4 years on average, right? And I mean, as far as I know, I'm with you, Jesse. Definitely not an expert by any means, but as I understand it, there's no realistic way of thinking what's worked for you over the past cycle will continue to work moving forward. So you have to always be rethinking your strategy, both in terms of your capital expenditures, your physical setup, your geo arbitrage, if you will. I mean, there's so many things that go into it, right?
Yeah. And I'm curious, Andy, have you conversed with a lot of miners looking to hire this cycle?
We are starting to have conversations with miners, which, my limited view here, my lens is that obviously that's a positive. Miners are kicking the tires. They are hiring. They're hiring everything from on-site technicians up to, senior level corporate roles. So that alone is a bullish indicator in my view, right? But I know there's an interesting point to couple that where, yes, miners are starting to hire, but there's an interesting perception from the candidate viewpoint where it's is mining a safe place to be in, right? And so these are kind of conversations we're trying to have and convincing people to come off the ledge, so to speak, to move forward with a mining client, where actually my argument is if they are still around today, right? And if they are profitable such that they're hiring again, then that's actually all you really need to know. We've kind of seen, for the most part at least, most of the inefficient mining businesses kind of clear out over the past year or two. So yeah, from my view, just as a recruiter helping to build mining businesses, I think they're all very bullish right now.
Andy, when those miners are coming to you, are there specific industries that they're looking to outside of mining or outside of Bitcoin to say, we would love to have a candidate from XYZ industry? And of course you have, you have operational aspects of the mining operation. You have the executive level or the finance. I mean, there's obviously so many different components, but
it differs across the size of the mining organization itself, as well as the discipline for which they're hiring, right? So on the more like on-site, technician, site manager type roles, you're seeing increasingly people move within Bitcoin mining, which is interesting. So you actually already have experience with one miner, you're now just taking that to another. Maybe your other business went out of business, right? Or you're just continuing to move forward for a number of reasons, right? So that kind of like circular movement is starting to happen in this cycle. Beyond that, we're still, of course, looking at like, let's bucket this broadly as like IT technician type things. You've come from Amazon data centers or some other large data farm like that, where, generally speaking, there's a lot of translatable skill sets. Of course, you're not like super well versed on ASICs themselves. Maybe there's some ramp up period there, but in terms of like network, infrastructure and engineering, things like that, we do see a lot of people coming from that space too. And then on the corporate side, that's where it is pretty interesting as well, because an early stage mining startup may want a tech type person who's operated in that early stage environment, whereas some of the more public miners, they actually want public company experience, right? Let's say you're hiring a finance role for one of the largest miners in the space. You probably want that person coming from a Fortune 50, Fortune 100, and maybe having traditional finance experience as well, just bringing that operation and that rigor into the mining industry as well. Mm-hmm. So the short answer, there's no one bucket. And the good thing for us is that we are then able to position that and as such for all these candidates as well. There's not one type of background that's relevant for mining. If mining is something that's of interest to you, there's increasingly going to be an opportunity for you, no matter what your background or skill set is, I would say.
Go ahead, Mike. Go ahead, Marty.
I was going to say, the mining industry, Cam, you alluded to, it's extremely masochistic. It's the most hyper-competitive industry I've ever been a part of in my life. For those who are unaware, I was one of the first team members of Great American Mining, which spun up back in 2018. We focused heavily on off-grid mining, particularly on upstream oil and gas wells to do flare mitigation. We were one of the first out there after upstream and Croesus up in the Bakken, helping oil and gas companies to mitigate their flare. And that was an extremely fun time in my life. Learned a lot about the dynamics and really got thrown headfirst into this hyper-competitive market. And really the name of the game is it's capital management, treasury management, financing your operation the correct way, having a good mixture of debt and equity financing, and then really timing the market. Timing the ASIC purchases is probably one of the most important things. And then obviously the other most important thing is your energy cost, your all-in energy cost. And that is a sort of moving target at any given point in time. And my favorite description of miners comes from John Seth. He describes miners as energy pirates. And so miners are just engaged in this massive game of energy price arbitrage, always looking for the lowest cost energy possible. And again, that's a moving target. At Great American Mining, there was a period of time, particularly in 2020, when the oil price went negative temporarily. That was a great time to lock in genset prices for your leases, which generators for off-grid miners is what produces the electricity. And if you can lock in a low-cost lease for many years, that was a great time to get in. And also, that was post-halving 2020. At that time, ASICs were really cheap, so that was probably one of the most opportune times to get into the industry in the last decade. But that changes quickly. You had the war in Ukraine breakout, which led to an energy crisis, and then off-grid mining, if you were getting into it in late 2021, throughout 2022, the economics simply didn't make sense. The demand for gensets in the oil field went up significantly as the price of oil and gas began to climb back up. And so you just have all these moving variables, and timing and capital deployment, doing capital deployment very strategically is how you're going to win and actually survive in the mining industry.
That's a great point. Have you ever seen that triangle that Bob Burnett has put together to try to really illustrate that dynamic? So it's three, I can't remember if he calls it a three-legged stool idea, but that at different times in the market, you're going to be without one of these legs of the stool. You're either going to have you're balancing the cost of the energy, the cost of the infrastructure, and then the availability of capital. So you can see how when you're in the bull market, the capital is there, but then the infrastructure is expensive, and then you have to see what your energy costs are. Right now, like you said, the cost per terahash for the miners couldn't be lower, but then the capital, unless you're a public miner, is really hard to obtain. So to find the right place to enter the market where all three of those aspects of that business formation are favorable and will get you through the next 4 years, very difficult to find that entry.
It's a good point too that one of the things I remember from the peak of the last bull market was having a conversation with a mining technology company, a guy from this company, and he said that right now, this was at the top, right now it's 6 times more cost effective to invest in mining than it is to just buy Bitcoin. And that in hindsight, that's the reason I always think about that, is because in hindsight, that was a top indicator. That was a frothy market where it actually at that point in time looked extremely attractive to invest in mining. And that ended up being the worst possible time to be investing in mining, because from that point forward, miners were over-investing, and a lot of them got washed out because their balance sheets weren't healthy enough to survive a major bear market. The drawdown plus the amount of time that you have to survive through those conditions. And so it is a good watch out that I guess one of the lessons, one of the few mining lessons that I've internalized is that investing in mining is usually best when it looks the worst, and almost certainly a bad idea when it looks the best.
Yeah, that's, I think, going back to that three-legged stool problem that you were describing, Cam, I think the best lesson that miners have learned over the last few years is it's really being patient on the capital side of things. Like Jesse was just describing, at the peak of top of the last bull market, everybody was deploying their capital and holding on to their Bitcoin. And it's really interesting for the publicly traded miners specifically, because they're essentially used as high beta Bitcoin exposure plays. And when the bull market's ripping, historically that's been the case. Who knows if that'll change if the ETF comes to the market and you really don't need to get exposure to Bitcoin via mining stocks, and you're able to do that via an ETF. It'll be interesting to see how those dynamics play out going forward. But historically, mining stocks have been sort of high beta plays, high beta Bitcoin exposure plays for equity investors. But with that being said, I think these publicly traded miners are specifically in a predicament, thinking about being patient for capital, with capital, and being smart with capital. Like there was a lot of companies, Core Scientific specifically, I mean, they just got out of bankruptcy and they wound up selling a large portion of their Bitcoin treasury at I believe, at $20,000, when it would have been much more advantageous for them to scrape some off their balance sheet when Bitcoin is trading at 60,000, 65,000, whatever it may have been. But at that point in time, when the bull market's ripping, you can see how equity investors could really see that as a negative, selling part of your Bitcoin treasury when the price is ripping. You're not getting as much high beta on that. But if you're thinking in the long term, it probably is the best strategy to deploy, to lock in some cash so that you can then redeploy once the bull market settles down and we go back into a bear cycle.
I do wonder, there's obviously a huge difference between the individual investor and the mining, certainly public mining company, right? But what's the adage for all of us as Bitcoin holders, right? Don't trade, don't try to get queued, don't try to time things right. Just stay humble, stack sats, right? I mean that's what we're told. Stay humble, right? That part means stay solvent. Do what you have to do, manage your cash flow situation the right way. So does that strategy or that philosophy have a place in mining companies where it's like you're earning Bitcoin, you're keeping Bitcoin on the balance sheet, it's going to go up and down, but it's almost out of sight, out of mind. Now where you have to be laser focused is your fiat management, if you will. So again, your if you're public, managing that whole side of the market. If you are a private company, your debt financing versus your equity financing, and again, thinking of like fiat strategy versus just Bitcoin hodling strategy. Does that make sense for miners even?
Well, if they want to survive in the long term, I think they have, like, over the long term, yes, it makes sense. Like, you should be building your Bitcoin treasury bigger and bigger each cycle. But with that being said, you do have to be smart with it to lock in that cash so that you can redeploy and not have to dilute your company, whether you're private or public, dilute your shareholders, or get into some pretty, that's what I'm looking for, like predatory financing, because mining is high risk and that's going to be a high cost of capital to actually finance anything on the debt side of things.
That's fair.
Yeah. It's interesting too, to like, in the way that I think about and talk about mining, it's sort of, I fall into the trap of talking about the glory days of 2021 and how hot mining was then, as if it is over, as if it is like past its peak and the high water mark won't be regained. But this is emblematic of how Bitcoin grows in general, with higher highs and higher lows, and the higher lows being the key part. And the mining industry is subject to that as well. And so it will be very exciting to see how in this next bull market, the global Bitcoin mining industry will be much bigger than it was in 2021. And it will probably feel much more present in our lives too. As hot as all those IPOing Bitcoin mining companies were in 2021, there were only a handful of them, and there may be quite a few more in this next bull market in the next 18, 24 months. And, I have a salient personal anecdote on this of I just drove through West Texas, and I was stunned at how many gas flares I saw driving on the 10. Because in my mind, all these opportunities for taking unused energy and channeling it into Bitcoin mining have been explored for years now by Bitcoin miners. But it's indicative of how many of the landowners, the mineral rights owners, have yet to accept that Bitcoin is a legitimate addition to their existing business models. And every single gas flare that you see whenever you fly in a plane at night over West Texas or the South China Sea, for that matter, or anywhere where there's a bunch of gas flares, and you see all those pinpricks of orange light, and every single one of those is a small scale Bitcoin mining operation that is yet to come into existence, but will. That's how early we still are for Bitcoin mining.
Yeah, I'm actually happy that we just settled on talking about mining, because again, it's so fascinating. There's such a deep rabbit hole, and there's so many lessons that have been learned again in this cycle. And the industry has certainly matured over the last 3 years, particularly post China mining ban. A lot of that hash rate has moved to America. We've talked about that in previous episodes, and the industry here in the United States has really matured. But with that being said, there are still a lot of things that can come to market that can help this market mature more. Hedging products specifically, that's a lot of the risk that we're talking about on the capital side of things, is as high as it is because there's not really sufficient hedging strategies. Some miners have employed energy cost hedging strategies, which has helped them out significantly. I know Riot does that, and others here in Texas. That's certainly going to allow them to manage their balance sheets more wisely moving forward. The whole conversation around hash rate derivatives and forwards contracts and being able to hedge your hash rate exposure. There's been people talking about that and trying to bring products to market for years. If we're being honest, that market hasn't really matured to the point where it's material yet, but there's companies like Luxor, Biduda, and others that are trying to really jumpstart that hedging of hash rate market that should allow miners to hedge risk more appropriately moving forward, which will certainly help the robustness of the industry and the companies within it. And then on top of that, just operationally, I think the market is learning on the go. And I think a big trend that we're going to see during this next cycle is a lot of miners moving behind the meter. So getting their electricity like at the power plant before it even hits the grid, which dictates lower pricing and more control over that power by the mining industry. But I think for the context of this show and the audience that we're speaking to, which is institutional investors, I think that's one thing that anybody listening should really internalize, is that really mining, I wholeheartedly believe, is an energy play at the end of the day. And what we're witnessing is the beginning of the sort of merging of the Bitcoin mining industry and the energy sector. And Bitcoin mining is going to be a very pivotal tool for energy producers or utilities or power plants.
I also think of it simply from the technological advancements that are sure to happen. So all we've talked about now is operational efficiencies. Miners, yes, they're continuing to learn through each cycle how to be more efficient. This is great, and that will continue. But just the process of turning energy play, yes, but the process of turning energy into hash rate, like more efficient machines, more efficient chips, if you will, increased competition from more hiring that happens in the Bitcoin landscape, but also the Intels, the AMDs of the world, right? So I think of this like maybe the techno-optimist lens, if you will. It's like, of course, the devices themselves will continue to increase in efficiency to a place that we don't even understand yet, right? And then the whole energy abundance conversation. I mean, we're looking at a future that could be very different, right, from access to energy and energy abundance standpoint, right? And so all of this will affect mining in ways that we just can't even comprehend yet.
Yeah, it's cool too how we stumbled into talking about mining, but it keeps hitting me how mining is like this very tangible example of how Bitcoin infrastructure is still in this very early days. And then Andy, what we're going to get into talking about here is how you are helping companies build out their hiring, solving that problem. You're building out some of the infrastructure for how businesses operate and the functions that they need to fulfill, hiring, in order to grow an industry. And so it's kind of a funny parallel how mining is this very tangible infrastructure development process, but all these other behind the scenes businesses that need to exist in order for an industry to operate are also developing. And that's what you guys are at the forefront of doing.
It's true. I mean, I say this for all companies in all roles where, the best of the best, we have a great community here in Bitcoin. It's gotten us to where we are. It's fantastic, but we're still just scratching the surface. There are so many people still stuck on these islands, if you will, in traditional finance, traditional tech, startup landscape. They just haven't opened their eyes yet. Don't understand that Bitcoin is where they should be spending their time and effort, right? And so that certainly applies to the mining space too. I mean, when you think of the computational power required for AI or for self-driving, like some of these amazing engineering minds working on those problems, they should also see Bitcoin mining as part of that. Now, I don't think that's a crazy thing to say. Like, why is it so beyond obvious that AI is the most interesting place to work? It's going to be an amazing part of our future, yes, but I think I'd throw Bitcoin mining and creating more efficient technology there. I'd throw that into the arena as something that's equally as important for humankind.
Yeah, and just beating the drum of all the efficiencies that are being made operationally too. Like, again, this industry is so nascent. It's almost been like a bunch of cavemen just plugging in computers and trying to get the most hash rate as possible so they can accumulate as much Bitcoin. That's what the mining industry has essentially been or was for the first, let's say, 10 years since ASICs were released in around 2013. But now, with the competitive nature and the competitive landscape of the industry, it's becoming more hyper competitive. Like, the edge that an individual miner can get is really beginning to surface, and this is particularly being very calculated with how you manage your hash rate. And so Cathedra, which I'm on the board of directors of, publicly traded miner out of Canada, with all of our operations are in the US though. But one thing that they did this last cycle was really hone in on their underclocking strategies. So Bitcoin miners run firmware that allow you to essentially draw less power. And if you can draw less power, but have the ratio of hash rate produced for that power remain relatively high, you can increase your profit margins. And so that's one example of an operational efficiency, really managing how much hash rate each individual machine is producing by manipulating the firmware to either underclock when conditions are very bad, and then overclock when they're really good, is something that is, I think, going to become more professionalized moving through this cycle too. You're going to see a lot of sort of hashboard level efficiencies that are dictated by software that react to where the price of Bitcoin is at any given point in time, where your electricity cost is at any given point in time, and where the hash price is at any given point in time. And so the room to create operational efficiencies that really drive optimal margin for these businesses is something that's going to develop as well.
I have a related question that you're the guy to ask this to, Marty. So now we're seeing the development of like heat waste utilization for various applications, and that makes me wonder, going forward, are there diseconomies of scale? Are there diseconomies of scale for Bitcoin mining when those large scale Bitcoin miners are competing with like home deployments of a couple miners heating your house in the winter? And obviously the advantage that small scale Bitcoin mine has is that it is getting two birds for one stone. You know, you're paying your heating bill and you're mining Bitcoin with the same energy. So does that move the needle towards it becomes more efficient, more cost effective to mine when there's a heat use application for that otherwise wasted heat that the miners are generating? Yeah. So are we going to see a shift from large scale mines to this two birds, one stone sort of requirement of like, you have to be heating Olympics swimming pool with your Bitcoin mine for it to make sense and be competitive enough?
I think it's going to work at both ends of the market, right? Because that diseconomies of scale on our smaller end, yes, like you're going to have an advantage if you can use the waste heat to drive down your cost of heat. So you said it's paying your electricity bill for your heating bill, but really you're not. It's like actually reducing your heating bill because you don't have to right. run your heater. You can just run your ASIC, and that ASIC is going to produce Bitcoin. And so you don't have to turn your heat on. You just turn your miner on. Your miner's producing revenue. And so your energy bill or your heating bill gets reduced. Your energy bill may stay static, but you're making Bitcoin in that mining, from that mining operation. It's going to work there. But then on the other end of the spectrum, with the large miners, they have economies of scale, which allow them to dictate pricing the electricity. And so they're able to get very low cost electricity. And then on top of that, particularly here in Texas, they're able to participate in demand response programs that allow them to get extra revenue for selling their electricity back to the grid when prices are high. And so they're able to lock in higher revenues from selling that electricity instead of mining with it. So I think it's going to work on both ends of the spectrum, which is actually a pretty beautiful thing. The diseconomies of scale that are afforded to these smaller miners actually helps distribute hash rate more granularly geographically and from an ownership perspective, which is very important for the strength and overall security of the network in the long term.
And it seems like we could head towards a world, maybe it's 5-10 years from now, where you have these sort of turnkey Bitcoin miners at home that take care of your heating and mine Bitcoin, or take care of your heating your jacuzzi or pool or whatever, and mine Bitcoin. And that could become like, so that barbell sort of thing that you're talking about there, Marty, of like, we could have a really sustainable consumer side of the Bitcoin mining industry because of the use case of putting that otherwise wasted heat to work.
Yeah.
Pretty cool.
Yeah, it's really cool. It's the energy currency of the world, is Bitcoin. It's insane. And we discussed this last week when we were talking about the Ethereum ETF, but that's like one thing when it comes to like proof of work versus proof of stake. That's why it's almost poetic and somewhat cosmic and beautiful, is like Bitcoin particularly via proof of work in the mining industry, is you're creating this digital money with a direct connection to the physical world. So it's like a melding of the physical and the digital via energy, electricity that enables miners to produce the hashes that allow them to add blocks to the network that reward them in this digital currency called Bitcoin. We're really melding the physical and the digital world together pretty directly via Bitcoin.
So Satoshi was a fan of Henry Ford, right?
Henry Ford, Buckminster Fuller, Nikola Tesla, all these guys. This idea has been out there for a while. Henry Ford wrote an op-ed, I believe in the New York Inquirer, when it was still around more than 100 years ago. And he said, if we're going to have peace on Earth, we're going to need an energy-backed currency.
Was Satoshi aware of that line of thinking? Was he deliberately thinking that Bitcoin would be energy money?
I don't know. I'm not sure. Because if you read the white paper, Satoshi talks a lot about one CPU, one vote. And I don't think he foresaw the competitive landscape that would evolve to attain Bitcoin. I can't say for sure, but many people think he was running with the assumption that you'd just be able to mine Bitcoin on your CPU into perpetuity. And it's funny, Laszlo, the guy who's most famous for spending 10,000 Bitcoin on pizza, he was actually the first person to build a GPU miner. And Satoshi at the time asked him to hold off from releasing his GPU miner because he didn't think the network was sort of robust enough at that point. And if a bunch of GPUs came on, it could really consolidate the supply of Bitcoin in very few hands. So I think the progression of the computing power dedicated to Bitcoin mining was something that was a bit of a unforeseen consequence that Satoshi didn't really take into consideration.
There, and again, is the beauty of proof of work, right? So I would wager that Satoshi probably looked at proof of work as like the mechanism for security, right? I mean, that's kind of his view at the time, right? Making, no double spending, things like that, right? So that was probably the lens through which he was viewing early on, with no anticipation, I expect, of like the entire mining industry that would set up to the adjacent to Bitcoin, right? And so again, the proof of work is beautiful because I think that will continue. Well, we'll continue to see examples of that, right? Mining will come out, other devices will come out, like the ways that proof of work kind of manifests itself across the industry will continue to evolve and change too.
Yeah, it's so beautiful is the right word because, when you address a problem, when you create an innovation that's so high level, it's really impossible to imagine all of the downstream effects of that. And it's like inventing the transistor or inventing a CPU or inventing electricity. Like you have no ability
inventing
to
the internet, right?
Yeah, anything that's high level like that, it's beautiful because you can attack that problem at a high level, abstract, conceptual way, and if you have a breakthrough, then it unlocks untold levels of innovation downstream of that you as the inventor cannot possibly imagine. You're not thinking that this could happen. This happens in math too, where E equals MC squared like leads to the A bomb and our nuclear world. That wasn't really envisioned, I think, by Einstein or Nash equilibriums with game theory. Like the applications of those in all of finance have been way beyond what John Nash envisioned. So it's such a beautiful thing when that happens, and there's nothing more high level and that leads to more downstream effects than changing the money for a society. And the proof of work innovation of that, bringing proof of work back to money, then changes every industry that touches money, and the manufacture of money being the most immediate of those.
I think again of your main audience here, right? The investor, the institutional investor, right? Is this perhaps why it's been harder to grasp up until just recently? Investing in Bitcoin. Why does it make sense? Because you use this analogy again of inventing Bitcoin, or the Bitcoin invention was like the invention of the internet, right? But you can never invest in the internet singularly, right? Like maybe early on you're investing in Alta Vista or AOL, and that actually turned out to be not so great for you long term. Or you invested in Webvan, or all these kinds of things, right? Over time, there were companies built on the internet that some were successful, some were not. But you were never investing in the internet in the same way that you're investing in Bitcoin right now. So again, investors who have gone through these cycles in the past, has that been a hard thing to grok? And like, well, shit, I should just be buying Bitcoin, because no matter what happens, like Bitcoin's going to rise in value. Other things will come and go built on top of it, but Bitcoin will always be the central point of that.
Yeah. It's a topic I've been wrestling with, how to articulate that, how to translate that simply into educational content. And over the years, and I have a graphic that sort of shows how the internet of information is this thriving city built on TCP/IP, the protocol underneath, and how now we have the early stages of the internet of value developing, and it's built on a protocol for storing and exchanging value that people are going to gravitate towards, because the network effect ends up winning. And this is the story of open protocols. It's why we use TCP/IP for everything on the internet. You don't have to. You could build your internet application on a different version of the internet, but literally nobody's there. So why would you do that? This is how protocol standards emerge. And I think there's a big misconception that remains today when people take a look at the cryptocurrency landscape and they see 30,000 different cryptocurrencies, and they all look like startups. They all feel like internet startups. And in the internet, you couldn't invest in the protocol layer. You could only invest in the internet startups, which are building on the application layer, building on top of the protocol layer, using the TCP/IP and the rules set there in order to build their business on top of that. And that's all that we know, because we've never seen a digital protocol war where it was possible to invest in the protocol layer. And so we mistake, when we come into cryptocurrencies, we all mistake the cryptocurrencies for internet startups, when really they are competing protocols. And so that's a winner takes all war that plays out when and eventually a protocol standard emerges, that if you're not on that protocol, if you're not in that ecosystem, your investment goes to zero. And obviously, we, having reached the Bitcoin, the level of understanding necessary to recognize that Bitcoin is winning that battle, has already won that battle. But most of the world still is coming in fresh and projecting what we learned from the internet to what we see in the cryptocurrency landscape, with all of these 30,000 startup looking things competing, and we assume it's just like the internet. But no, it's a protocol war, and there will only be one.
There is no second best, Laura.
Jesse, you say you've struggled to articulate that simply. I think that was just it. I think that actually makes a ton of sense, right? It's the idea of competing startups, or, well, if Bitcoin is great, then what about this new one that's faster? Like, that startup will obviously do well, right? Or this one that can more transactions per second, whatever kinds of things you would pitch to say why this random protocol or token is better than Bitcoin. Obviously, we know it's not true, right? But that's like the marketing strategy up to this point. Think of it, however, as competing protocols. And if it is going to be winner take all, how is Bitcoin not going to win at this point, right?
That, and for the building on this conversation, go ahead, Cam.
Oh, sure. So, given your experience at Uber, and there's some interesting analogies there, I think, where Uber is this downstream business that maybe or may not was foreseen by some of the early internet pioneers, but pretty revolutionary. You can step outside on the sidewalk, press a button, and the car flies up to the curb, and you get in with a total stranger, and then they take you to wherever you need to go for a reasonable price. There's a lot of trust that goes into some of those first rides. When you get into maybe an Uber for the first time with someone from an older generation, or maybe our parents' age, that's a pretty scary concept. Even though in some ways it's also kind of scary to you flag your hand up in New York and a yellow cab comes over. I mean, that's someone you don't know either, but there's so much trust and reliance in the technology and the vetting of the drivers and those things. So I think there's some decent corollaries to Bitcoin where we're also shepherding people into a new technology that has profound implications. Are you seeing, how are companies thinking about finding some of those people to help build their businesses that can translate what this technology means and how it can be used by everyday people?
Well, I think the biggest learning up front is this. We had this phenomenon, if you will, early on in Uber, where there ended up being this whole crop of Uber for X, right? Uber for dog walking, Uber for haircuts, Uber for whatever, right? I mean, there were so many businesses. Some ended up being somewhat successful, gaining enough, economies of scale or enough like a network effect, right? But for the most part, it's like at Uber, we would always say like, we are that. Right, we've already built the largest network effect. Like, why can't we offer all kinds of other services on this marketplace, right? And so, not getting to your core question yet, but I think companies should realize that again, or investors even should realize that. Like, there's not going to be the Solana is the Bitcoin for speed, or Ethereum is the Bitcoin, whatever you want to say, right? Like, that doesn't exist. Like, Bitcoin is the one that's already built that network effect and is the most secure. Kind of related to what we had with Uber early on, right? Now, you are increasingly seeing across the landscape, I mean, whether it's an exchange or a consumer product, this or that, like people are starting to open their eyes to the fact that there is a lot of talent in traditional tech that has already tackled some of these problems. Like, how do you get viral growth? Right? How do you have the best user experience, right? From an actual product design or UI UX kind of thing. So those realizations are starting to happen across Bitcoin companies now. And that excites me because we're finally getting to a point where Bitcoin is mature enough to have our pitch to potential candidates be better received, right? Orange pilling along the way to getting people a role in Bitcoin. But the companies are actually demanding this talent too. We're not just looking for talent on Bitcoin Twitter anymore. We're actually looking broadly and trying to bring the best of the best into the space.
We need it. Bitcoin needs better UX, better UI, better minds.
I teed that up for Marty. It's his message. I love it.
Yeah. I've said it before, and I truly believe this. Like, if you want to leave your mark on the world, we have a relatively blank canvas over here in the Bitcoin industry. So if you're a UX, UI designer, Bitcoin, the way in which it works, how you receive, send transactions at the protocol level via Lightning with other solutions like Liquid and Fedimints that are coming to market. Like, these are brand new experiences and brand new ways of interacting with money. Like just a private public key pair. How do you manage new addresses? How do you articulate that a user is interacting with a new address? How do you articulate that if you're going to send a transaction, maybe you should make it a replace by fee transaction, so that if it gets stuck in the mempool, you can increase your fee to make sure that it gets into a block in a timely manner. Like, these are all user experience problems that have been solved up to this point mainly by protocol engineers who don't really have the best design minds in the world. So if you're a designer looking to leave your mark on your industry, like, this is a blank canvas to come build new experiences and UIs that help articulate to end users how to actually interact with Bitcoin the right way, to make sure that you're not gunfooting yourself or spending too much money on fees, or your coin selection is done in a way that makes it as efficient and optimal as possible. Like, there's so many different variables to interacting with Bitcoin that literally need user experience design around it to really make sure this is as easy and efficient as possible for end users.
Yeah, technology often falls flat, not because of the technology itself, but because of the friction or the poor user experience. I mean, there's so many examples of this, right? So the talent needs to be here. When we think of Bitcoin for the masses, that means we have to accept this, may be controversial, right? But that means a world where it's Bitcoin for people who are not running nodes, who are not super savvy on self-custody, even though we need to keep beating the self-custody drum. Like, we need between now and then to be building products that just make it so stupidly simple to interact with the protocol.
Thanks for tuning in to The Last Trade. If you're enjoying the show and want to dive deeper, check us out at onrampbitcoin.com, where you'll find a full suite of institutional-grade research and analytics, including our recently published white paper, Bitcoin's Full Potential Valuation, and our new tool, the Onramp Terminal. Now, back to the show.
I was just recalling how I had a class at Stanford from a venture capitalist there called Andy Ratcliffe, who co-founded Wealthfront, and his main message to my class and everybody who talks to is that the best opportunities for your career are with companies that are going through high growth and sustained high growth. In particular, you want to join a company that is clearly on a trajectory of high growth, because it will accelerate your career the most. And obviously, the connections to Bitcoin here are pretty evident, because Wealthfront puts out a list of 150 or 200 of these companies every year that they're traditional tech startups that are, I guess, seeing, I don't know if it's 50% annualized or 100% annualized growth for several years. But that's what Bitcoin is doing and Bitcoin companies are doing. I don't think Bitcoin companies are on his radar at all, because you have to take that leap. You have to understand that Bitcoin is a rising tide that is going to lift all boats, and it has been and will continue doing so because of its inherent properties and internal mechanics, and obviously the value proposition to the world of what Bitcoin represents for your portfolio. And so that, there's sort of a connection there of Bitcoin. Any Bitcoin company really could be on that list or should be on that list, even though they're not going to give the time of day to Bitcoin companies. But if you get deep enough down the rabbit hole to understand that the Bitcoin industry is going to keep growing a ton, then perhaps the best thing you can do for your career is be a part of that by joining a Bitcoin company that has seen some growth and is on a trajectory to grow a lot more as the Bitcoin tide lifts all the boats with it, and accelerates that growth. So a random bit from my past that I realized is a part of what you're doing, Andy.
That's a great point. Just as a follow-on to that, Andy, what type of reasons are you seeing, are you hearing from candidates in terms of why they're interested in working on Bitcoin? Because there's a few different aspects that could come to mind. One would be them seeing Jesse's thesis that this is one of the largest growth industries and will continue to be and change the world in as profound a way, or possibly more so than the internet itself, and that the chance to be at an early Google or Yahoo or Uber is one of the savviest moves you could make for your career? Or is it more ideological and wanting to kind of put your mark on the world and look at this as a very high leverage way to make positive change in the world as you see it? What are some of the reasons you're hearing from folks?
Yeah, I mean, that last piece is definitely a huge part, just ideologically people aligning with Bitcoin. But that's almost like the people who are already here, I would say. And so what I'm seeing is three broad buckets of folks coming into our pipelines, or just with whom we're having conversations. So first is, again, that bucket of folks who are here. They get it. They may not be working in Bitcoin yet, but they're definitely Bitcoiners, right? They've taken their journey. They've gone through the learnings, whatever detours along the way. They know that Bitcoin is what they want to focus on. And so very actively trying to transition their careers from wherever they may be today to Bitcoin. That's bucket one. Bucket two, which I think this is one that also makes a lot of sense, is the refugees, if you will, from crypto, Web3 broadly, right? Where there's a lot of discussion around this in the Bitcoin landscape. Yeah, every company has their own particular viewpoint and philosophy. I never want to touch someone who spent time at a crypto company or those who are more welcoming. I personally am of that latter viewpoint, where we've got to be a little more pragmatic around this. I'm not going to fault someone who went into crypto, let's say 3-4 years ago. Perhaps it was an insanely high salary offer, right? I mean, we know there was a lot of capital in that space. And so there's all these reasons why folks chose to pursue a career there. The one that I like to reference is maybe just taking chances. I like people who take chances, jump into the unknown, who are a little risk averse in that sense, right? But again, those people who, after having spent time in a crypto environment, have woken up to like, okay, well, actually Bitcoin is pretty different. And I'm stating today, I want to work in a Bitcoin only company. So we see a ton of that. Not surprising. It's also very encouraging that we're seeing that, right? The third bucket is which I think is still the largest one and will be a huge part of where our future talent comes from through this next cycle, is folks who are curious, right? They're not dying to get into Bitcoin. They're not, your bleeding heart, carnivore, whatever all the culture warrior type Bitcoin stuff we think about. Like it's not that crowd, right? But they're starting to get curious. They're starting to understand there's something to it, right? And I also am encouraged by this last demographic because I think there's now a direct entry point into Bitcoin that does not require you to take your detours through crypto. I hope, and I just maybe the chip on my shoulder, having gone through my own pain. Jesse, I know you have this story too of spending time on the other side of the fence and learning mistakes, learning the hard way, right? I do believe that more and more people will come into Bitcoin in this next cycle, directly into Bitcoin because they've already understood the difference. They've seen the blowups of the last cycle. They see the legitimacy and the narrative shift that's happening with the ETFs and things like that, accounting rules that are changing, more Bitcoin held on corporate treasuries outside of the Bitcoin landscape, right? So long-winded answer for you, Cam, but yeah, there's like those three buckets of people. And oddly enough, I think that last bucket, the one that is not yet in Bitcoin or not even yet Bitcoiners, they will constitute a large part of our talent pool moving forward.
Yeah, and to sort of tie this back to the first part of the conversation around mining, that's something that really gave me peace of mind in 2018, 2019, as I was getting into the mining industry. Like you'll hear a bunch of buzzwords and a bunch of hype in altcoins. But at the end of the day, if you look at simply the energy expended to secure the Bitcoin network, it is orders and orders of magnitude larger than any of Bitcoin's quote unquote competitors in the altcoin space. And that is something that, despite any narrative that may pop up, come and go moving forward, any narrative that has popped up and come and went in the past, if you just were to look at a pure spreadsheet that had the data of the energy expended, and it would be very obvious to you that Bitcoin is really the only player in the room.
Yeah, it's certainly the only energy money. And if you understand that there needs to be some sort of link to real costs in the real world for a digital money to have value, and that energy is like the thing that makes sense because it's a way to have cost for creating the currency. You have to have some kind of cost, and energy is like the foundational cost of any real world activity. And so that can be the cost, and that works well with the digital landscape because, energy is this ephemeral thing, this real world thing that is, doesn't have like a materiality to it in a traditional sense, but it requires physical capex to create. But then, it obviously powers the digital world. So that's the link. And you need to have some link to real world cost. It can't just be, proof of stake where, I bought this asset, so that's my investment, and therefore I should get a right to vote in how more currency units are created in the future. That doesn't work because that's how you get, the centralizing forces of a few people with the ability to control the currency's destiny, which is what's happening with Ethereum in slow motion, and any proof of stake coin as well. But so there has to be some link, and energy is the best link, and no other coin has any measurable energy footprint relative to Bitcoin. I mean, Marty, like you probably have a better sense for these numbers, but I would imagine that the energy expenditure of the next biggest coin that's a proof of work coin, I don't even know what that is. Is that like Litecoin? What's the number 2 in terms on the proof of work list in terms of energy expenditure? And I'm sure that energy expended is 0.001% of what Bitcoin does.
Yeah, I think Litecoin is probably number 2, maybe Monero. I'm looking at some charts here right now on coinwars.com, hash rate charts. Yeah, top 10. It goes Bitcoin, Litecoin, Monero, Zcash, Beam, which I've never heard of, Dash, Zen, and Ravencoin.
Never heard of the bottom half of that list.
Yeah.
And we can evaluate how we know that Litecoins, Litecoin came around. I don't actually even remember. Was it 2013, 2014, something like that? Maybe it's 2012, with the hypothesis of, well, Bitcoin can be gold and will be silver, right? And that'll work. Like you need a transactional currency to go with your gold, because you're not going to transact with your gold. That was the whole point of Litecoin. And then, the Lightning Network completely renders that useless. And yet it's still hanging around as the second biggest proof of work coin out there, just because there's no other competitor, there's no other network effect. You can't start a proof of work coin today and expect to get it off the ground, because the cost of 51% attacking it is nothing. For anyone who has any hardware, who's doing any kind of either Bitcoin mining or Ethereum mining or Litecoin mining, anybody could attack that new coin and keep it from having a sterling track record that's necessary for it to develop any kind of adoption and network effect. So the game is already over in terms of proof of work coins, and because there's 30,000 coins out there, people don't realize that, because you see 30,000 coins and you think that the competition is all even still. It's still happening, but you don't realize that almost all of those 30,000 are proof of stake of some kind, and proof of stake is by definition not a competitor, and you need to have some real world cost link. Yeah, here's Logan. Thanks for pulling that up. Here's the full set of possible contenders in the proof of work landscape.
Are these the only proof of work coins too? I know it's top 10, but are these the only? Whereas we have
no, these aren't the only.
Oh, goodness.
But there's thousands, or hundreds at least. But go up, Logan. I pulled this up because I really just want to conceptualize, help the listener really internalize just how much of an advantage Bitcoin has from an energy perspective. So Logan, click on the Litecoin chart, and we'll see here that Litecoin's overall network hash rate is 879.36 terahash per second. So it's not even 1 exahash. And so it's 879.36, and then go back, and then go to Bitcoin. Bitcoin is 482.7 exahash. So you need 1,000 terahash for exahash. So Bitcoin's
it's about 1/500th. Litecoin is about 1/500th.
Yeah. It's insane.
That's awesome. That's great. And that's only because Litecoin just still has some vestigial market value, because people still kind of believe that it has a place in a portfolio. And so that's the only reason why it has any value worth mining that would cause miners to point some hash rate to it in order to mine Litecoin and sell it on the market and move that into Bitcoin or dollars.
Yeah. It's again, there's nobody else. There's no other player on the field really that comes close to Bitcoin. And another thing too, Logan, pull up the screenshots I included above that link, because I think there's a big misconception. You hear that Bitcoin mining waste energy, and it's literally the exact opposite. Over time, Bitcoin mining has become extremely efficient. So this is a chart here, the Bitcoin hash rate, heat rate. So the amount of electricity needed to produce a terahash via Bitcoin miner. And so in 2009, you can't even see the charts, around like 20,000 joules per terahash in 2009. And in 2021, which is the last date that this chart goes to, was 31 joules per terahash. But we've had miners come to market since then. The S19 XP was 21.5 joules per terahash. So you had a 33% efficiency gain between the S17 and the S19. And here are the specs for the S21, which is coming out, which is at 17.5 joules per terahash. So that's a 25% efficiency gain. And this S21 is going to produce 200 terahash per second when the S19 produced, I believe, 140 terahash per second. So you have a 25% increase in energy efficiency, and you get a 43% hash rate gain on that. So Bitcoin mining as an industry, the ASICs have become extremely energy efficient. They can efficiently take a joule of energy and convert it into hashes at more efficient rates over time. So Bitcoin mining is actually becoming one of the most energy efficient industries in the world in terms of taking electricity and turning it into digital gold in Bitcoin.
Which is the beautiful aspect of capitalism, right? We're just relentlessly forcing all market participants to continue to improve and be more efficient. The other thing I was thinking about too is that if you're a potential investor and you're looking at all the options you have in cryptocurrencies to invest in, and where this dynamic of the amount of hash rate and energy being expended to secure Bitcoin versus all others, 500x versus the second competitor, it's such a crucial signal, because there's a real opportunity cost to either choose to be a miner and mine Bitcoin, or to choose one of the other protocols, because you can't be mining two cryptocurrencies simultaneously, in the same way that you can't invest your capital in both Bitcoin and some other cryptocurrency and have them be in two places at once. But this is sometimes the harder concept to wrap the head around, because with the internet you could do that. So oftentimes we hear the comparisons, well, isn't Bitcoin the MySpace of the industry? Surely it'll be outcompeted. But part of the difference there, in my view, is that you can be, as a user of those social platforms, you can be in multiple networks at once with very little switching costs. Whereas when it's your own capital and you can only put it one place at a time, you spend more time with that decision, and you learn and respond faster to the market feedback. And this is one that clearly miners are forming a consensus around. Bitcoin is the one that they're going to continue to invest millions of dollars of capital and months and years building out their operations around.
Yeah, it's
a good reminder. You can only ride one horse at a time.
Bitcoin's the fastest horse, baby.
Yeah,
it's Paul Tudor Jones says.
Texas now coming out with the cowboy metaphors. You love it.
I'll get a cowboy hat and boots soon enough.
There we go.
Yeah. And I guess to tie out this conversation too, we're talking heavily about mining, and I'm very pumped that we went down this rabbit hole, because I think it's important. I don't think we've done a mining deep dive on this show yet. With it, describe the dynamics of the mining industry up to this point, what may be on the horizon moving forward. But I think it's important to mention some headwinds too, which is the emergence of artificial intelligence, and that's a very energy intensive industry as well. And after the China mining ban and the migration to the United States and other parts of the world, it became abundantly clear that rack space and energy capacity is somewhat constrained. And now moving forward with the emergence of AI and its energy intensity, there's going to be a lot more competition for this electricity and this rack space moving forward. So that's another thing to pay attention to moving forward. I think in the long run, what you'll see is AI, HPC sort of data centers being co-located with Bitcoin miners. And that is because they want the lowest cost electricity possible too, to have the highest margins. It's very similar dynamics in that regard. However, with AI, with training models and running inference, you need 100% uptime, which means you can't really participate in demand response programs and be as profitable as you would like to. You want to train your models and get them to the market so that you can beat your competitors, and you need 100% uptime. And so I think, this is my thesis, is that in the future, what we'll see is co-located GPU farms doing AI computation with Bitcoin ASICs. And this is because you have a facility that's co-locating these two operations. You can get a lower cost of electricity because you can participate in demand response, because the ASIC part of your operation can respond to that demand in seconds and send that electricity back to the grid while you keep your GPUs on to do your AI computation. So I think in the early days, there'll be like very high competition, like AI operations and mining operations competing for scarce energy resources and infrastructure. But I think over time, the market will begin to recognize that they're actually somewhat symbiotic and help each other out in creating diverse revenue streams and lower pricing because of the demand response that Bitcoin enables.
I agree with that, Marty, because I think that's consistent with the trend that we've seen in mining of miners, in a sense, diversifying their operations, where maybe they started exclusively self-mining, but then expanded those services to also hosting a complementary service to help provide another and differentiated revenue stream, which would make sense to have, again, AI as part of your operation to help you get through those long and more unpredictable, in a sense. I have heard from some miners, though, that there is a potential for demand response programs for AI data centers. So I guess it depends on the use case of the AI itself. If it's longer term projects or use cases that then also don't necessarily require 100% uptime, there might actually be the potential there to participate in that demand response and provide even more favorable economics for that miner/AI data center.
Yeah, it depends. Again, if you're doing like model training versus inference, maybe on the inference side, you can have more disruptible load. And maybe people training particular models that think they have an edge in terms of the idea of the model they're training, and don't think anybody else is building it. Maybe they'll be more patient and be like, yeah, we can disrupt this model temporarily just to send electricity back to the grid. But there's also, I talked to somebody recently, like, we're certainly nowhere near that point yet due to the way, like, the data isn't backed up. Like, you can run a model training process and the data doesn't get backed up to RAM or anything. Like, you run the model and you have to finish the model and then you get the data. And so I think the way I understand it, again, I'm not an expert on this at all, but after this conversation with somebody who really knows what's going on, there really needs to be a solution to backing up the data on the go as you're training these models, before you can have something like a disruptible load added to your data center functionality. I'm sorry, I ran out of water. My throat's dry.
You're holding it together over there, Marty, huh?
Yeah. But I think beyond all this, AI, Bitcoin, very interesting, very energy intensive. I think we're at a critical crossroads in humanity too, where energy infrastructure has experienced a massive misallocation of capital. You should have a time coming out in the Bitcoin piece, the Bitcoin Times next month that really dives into this and dives into the way Germany really destroyed its energy infrastructure over the first 2 decades of this century. And that's one sort of headwind to worry about moving forward too. If the economies of the world don't get smart on energy, capital allocation, and infrastructure build out moving forward, there could be like material disruptions to the energy sector that make it harder to mine and do this AI computation.
Yeah, we are certainly a crossroads for all these things, and it's funny how we sort of walked through the second half of the last century, fooling ourselves into believing that energy was solved and not a problem, and that tech was everything that was exciting and new and important, and we've gone from a world where the rapid development of new energy sources like nuclear was had us on a track of pretty linear increasing energy abundance and prosperity, lifting people out of poverty. Going from that to the last several decades of kind of stagnating energy production and decommissioning nuclear power, and not investing in that stuff, and instead investing in much less energy efficient renewable energy, and thinking that link between energy abundance and prosperity didn't matter when for all of human history it has mattered. It's sort of an interesting parallel to fiat money and how having unbacked money that you can print more of has snuck into our reality in a way that as if there's no cost to it, as if there's no downside to being able to print as much money as you want. And we're collectively going to learn some hard lessons about both of these things, and hopefully the incentives in place for Bitcoin help mitigate and even entirely offset some of the painful lessons that are coming for people who do not adopt Bitcoin or want to stymie Bitcoin's the tailwind that Bitcoin provides to the energy industry for developing more energy production.
Yeah, and we'll give the last trade audience some alpha here. So Logan, pull up the third chart first, and then the first chart. This is just diving in. When I dove into these numbers on Germany over the first 2 decades of the century, it was actually pretty scary looking at what they did. So here's a chart of their energy generation capacity for nuclear, coal, and nat gas and fossil oil since 2002. So in 2002, the German grid had generation capacity for these sources at 97.7 gigawatts. Over the first 2 decades, over the last 20 years, that's fallen from 97.7 to 77 gigawatts. It's, I think, a 21% decrease in generation capacity for these fuel sources. Over that same period of time, you can go to the first chart, Logan. Overall capacity within the German grid has grown, I think, by 108%, and that has been led by solar and wind predominantly. So they've more than doubled the energy capacity on their grid, the generation capacity on their grid over the first 20 years, but that capacity has really been driven by wind and solar, and nuclear and nat gas particularly have been decommissioned and wound down. The result of all this is that prices for your average German household have gone up by 187% over that time period. So you've doubled the generation capacity over the last 20 years, but prices have doubled. And I don't have this chart here right now. Actually, let me see if I can find it real quick. But over that same period, overall generation has fallen by 2%. So you've doubled the generation capacity, essentially like the amount of grid infrastructure that could take on electricity that's produced, that's generated, but you've actually generated less energy because you're relying on unreliable sources like wind and solar. Prices have more than doubled, and over that same period, the German population has only grown by 2.7%. So there's a clear disconnection from reality. There's a lot of virtue signaling about net zero and climate change and ESG that simply, like, you can build all the generation capacity that you want, but it's the equivalent to what the Chinese are doing with these ghost cities. You can build this capacity, but if nobody comes to live in it, and if there's no electricity that comes to actually live within that grid, it's all for naught. And so, the beginning of the century, nuclear, nat gas, coal, and fossil oil made up 84% of the overall generation capacity. Today, it's 34%.
Yeah, wow. That is a problem. It's a big problem.
And I'm curious, Marty, as you've dug into that, I mean, are you already seeing or translating that perhaps to directions we are heading here at home?
Oh, yeah. I mean, certainly I wrote about it in the piece, too. It's like, This is a microcosm of a larger trend. Like, it's happening here in Texas, in West Texas. Massive wind and solar farms being spun up, and one can make a strong argument that's led to the relative instability of the grid during peak demand seasons in the middle of summer and winter over the last few years. Apparently, when it gets cold out, the clouds cover the sky, and the conditions are such that the windmills can freeze up and not produce wind. So you can have all that wind and solar capacity that actually can't produce. So you're forced to make up for that with like natural gas peaker plants and other forms of energy. Thank you, Logan, my savior.
That took a while.
So yeah, no, it can happen
Logan,
here.
where'd you get that from? Did you have to go all the way to CVS or something?
We have a kitchen here at the Commons.
So I guess what we're saying then is that Bitcoin is the nuclear, the nat gas, the oil. It's the true high dense energy source, and Ethereum is the wind and solar, where we think we out engineer reality and we can create our own new, better ways of energy. But really, what we're seeing is a reversion to the mean, and we need to get back to basics and go back to
funnily
forces that have gotten us here, right?
Funnily enough, Bitcoin fixes this. Like,
Of course.
It actually does.
all that was driven by the ability of the governments to print debt ad nauseum, print money ad nauseum, and then ESG mandates, which are driven by the Cantillon effect as well.
Yeah. Bitcoin reimposes economic reality, which fixes a lot of the malinvestment that has happened. So yeah, that's how Bitcoin fixes things.
Yeah. You're not going to be able to print money. You're not going to be able to issue a lot of debt if the opportunity cost of parting ways with Bitcoin is not going to be met by future production of the government that's taking on that debt. Like, this is what Germany did. What we're doing here in Texas is all fueled by subsidies in ESG virtue signaling, and Bitcoin really ends that if it gets widely adopted. And then you have like the second order effect, which is the mining industry, like just driving the economic incentive to actually create more reliable infrastructure so that miners can have 100% uptime and make as much profit as possible.
Yeah. I'm sure that's not part of your pitch to people you're talking to, Andy, about Bitcoin fixes things. But
well, I say, how much time do you have in our initial 30-minute screen here? I'm actually just going to link to this pod for every call moving forward.
Yeah, you thought you were talking about job opportunities in the Bitcoin industry, but you're about to learn about energy.
I mean, that's kind of the truth for all of us, right? Like, we all had our own entry point into Bitcoin, and I mean, what myriad of corners within Bitcoin have we now become, if not proficient, at least knowledgeable in, right?
Yeah, and there's an irony there too of like, we're not supposed to be experts on stuff, and we're not, and yet we seem to know more than the quote unquote experts out there on so many of these topics at this point, because we live in a world where Bitcoin has reimposed economic reality, and we've had to learn about reality, whereas so many experts are still living in unreality.
Yeah,
absolutely.
We got to get back to reality. That's another thing in the piece too. Like, we are very far away from humans gathering logs to stay warm. The population of the world, particularly in the Western developed world, does not understand reality without reliable electricity. And if we have a material enough disruption to our electrical infrastructure and the ability of people to simply turn on their lights, turn on their laptops, charge their phones, it's not going to be good. We are coddled and very far away from first principles, cutting down trees and starting fires to warm ourselves and produce energy in the world.
Charge their cars too. You forgot
charge the cars.
I'm one of those people who thinks about the Roman Empire rather frequently, on a weekly basis, at least. And, I can't help but think about how I'm sure that, so Rome was really 1,000 years. Its peak was like 600 years, really. And then late stage Rome was 300 years of slow, gradual decay. But, at that point in time, the psychology of a Roman citizen was that Rome had created civilization, and that civilization had lasted for so long already that it would last forever. So I'm sure that the mentality of the Roman citizen, as they continued to squabble amongst themselves and erode their currency and erode the strength of Rome, was that the aqueducts will always continue to bring water to Rome, and Rome will always remain strong. And we don't need to worry about those things. They've been solved.
Yeah. No, I think this energy problem right now is existential. We really need to stop LARPing and stop building unreliable energy infrastructure when we have on the most reliable energy we could ever want. We just don't have the political will to allow us to leverage it, which is very sad.
And that's, I think, what you do a great job of, Marty, is helping to change the narrative and educate people about not only Bitcoin, but energy as well, because I think there's been a malinvestment in human capital as well, where there's more, there's, when you have the ESG narrative, there's not as many people who want to be a roughneck in West Texas or to become a petroleum engineer, when those are critical roles that are high paying and afford a great life for folks. Similarly, that's one of the things I get most satisfaction seeing in Bitcoin mining, is that you're able to revitalize rural communities and provide high-paying jobs and skilled labor for the local workforce. So we're, so much of the kind of folks we think about when we associate with Bitcoin are the developers or the most technical people possible on the planet. So it's also refreshing to see some of these more blue collar working class communities also have an opportunity to participate in Bitcoin and be in this high growth industry.
Yeah.
It's actually an exceptionally fulfilling part of my job and what we're doing as a team right now too. I mean, I come from a world where venture-backed startups, you're hiring engineers, you're hiring from maybe 5 to 10 universities. They're all getting the same obscene compensation packages, right? And it's not obscene. It is what it is, right? Because of the level of competition, right? But it's just so very focused on that type of talent pool, if you will, where Bitcoin, those roles are important, yes, but everything else under the sun is as well. And my ability to now touch on different parts of that instead of just hiring the same type of person over and over again. I mean, it's so satisfying.
It is. Gentlemen, I was not expecting to dive deep down the mining and energy rabbit hole, but I'm very happy that we did.
Yeah, I'm happy as well. Andy, I hope that works for you. I don't think Andy was expecting that one.
No, I mean, it's kind of echoing what you said earlier, Jesse. Mining is something that I've started to become more aware of just because we have clients coming to us who want to hire, right? Mining clients, right? And I am woefully unknowledgeable around that as it relates to other parts of the Bitcoin ecosystem. That said, I'm as unknowledgeable as I am, I'm actually that excited and interested to learn more. So it's just been fascinating to dive deeper and deeper. Thankfully, having folks like Marty we can lean on to learn more. It's just been, so much more to dive into.
Yeah. Andy, do you want to... leaving this to the tail end here, but do you want to provide just a little overview of what you guys do, and for our audience, if they want to find out more, where should they go? You take the floor for a while here, because we talked about mining most of the time.
Well, for those of you that are still here, we appreciate you listening and staying tuned. So we launched Bitcoin Talent Co, myself and our team, towards the beginning of this year, in early spring. Really set out to be the first Bitcoin-only recruiting service. So again, my background is in recruiting and tech businesses. As we mentioned earlier, I was employed at Uber, coming from that type of world, right? Bringing that knowledge, that discipline, that rigor around recruiting into Bitcoin in a way that hasn't existed yet. So ourselves personally being Bitcoiners, we saw the opportunity to really draw the line in the sand. We don't touch crypto. We don't touch Web3. It's really supporting the Bitcoin ecosystem, bringing the right talent here to the space. This is all levels of experience, all disciplines, as long as it is for the mission of pushing Bitcoin forward, right? And even though it's been the depths of the bear market and really less than a full year of operation, we've actually already been able to accomplish that. It's been incredibly fulfilling, hiring a number of key roles across, again, all levels of experience, all disciplines for clients like Unchained, like Fedi. I could go on and on, a number of really, really exciting businesses that we've been able to partner with up to this point. And so if you are there listening, excited about Bitcoin, wanting to learn more, wanting to eventually work in Bitcoin, absolutely visit us, bitcointalent.co. You can always reach out to our team, myself personally. Happy to kind of walk you through the job hunt process. And then, of course, any companies that are looking, any Bitcoin companies that are looking to hire, but also any companies broadly that are looking to hire Bitcoiners, which I think is an important distinction. We're here to kind of help you through that process as well.
Yeah, you guys, it's a good point that you've only been operating in the bear market or sort of crab market of going sideways the last year. You guys are going to be really busy a year from now.
Yes, short answer. We're starting to see that already ticking up, and And we're excited about it. I mean, a lot of what we've been doing over the past few months too is preparing for that wave of new interest, new candidates, more companies with capital trying to hire. Right, it's going to be crazy, right? And so, spending a lot of time making our own services and products more robust to be able to respond to that demand. So, whether it's retained search for full-time executive roles, whether it's connecting you with contractors on our Flex platform, or even providing more like self-serve type tools through another platform that we're building right now. We're excited to really offer services at all ends of the spectrum, all price points for companies who need that help.
Yeah, one of those parts of an industry that is behind the scenes and people don't think about. But you are building this type of infrastructure. We spent we talked about Bitcoin mining infrastructure, and but this is the reality of business infrastructure. Like
human capital.
Human capital needs to be served in order for an industry to function, and you guys are helping to apply the grease to the cogs that make a whole industry run.
It's already been so valuable to me personally too. I'll put a personal plug in, Andy, that I talk, we get to, because of the nature of our jobs, get to talk to a lot of people who are already in Bitcoin or are seeking to break in. And I can provide my own recommendations for them as what parts of the industry might be interesting, or specific companies that might be interesting to look at, and make some introductions myself. But it's so nice having you guys as a resource to say, like, okay, definitely one of the first places you should start with is Andy, Eric team at the BTC Talent Co, because they have even a broader purview of the potential opportunities, and they're skilled at helping to understand, taking your skill set, what you're interested in, and then what's the most fulfilling way you can apply that in this industry. Thinking about it from the individual candidate perspective, but
cool. And we appreciate that. Yeah, again, for anyone listening, if you have friends, anyone's interested, send them our way too. We're happy to have those conversations.
I know there are many of you that listen to the show out there that are sitting in a cubicle right now doing some Excel functions for some terrible part of the industry that you really don't feel passionate about. And you're here because you're passionate about Bitcoin. You should reach out to Andy. You have a Bitcoin standard to build, and Andy knows all the teams out there that need help building. Get out of your cubicle. Get into the Bitcoin industry.
Save yourself. Save the world.
Look at Marty, not only delivering orange pills, but also quarter-life crisis existential pills.
I had it myself. I was in the cubicle running Excel functions, pulling data from Bloomberg, putting it into performance reports. One day, it was my birthday. Nobody said happy birthday to me, and I had enough.
Oh, wow.
I quit and got into Bitcoin. You can do it too. It's very risky. Your wife's not going to be happy, but it's worth it on the other side.
Yeah, it's especially if this is the rising tide, and bringing it back to that Andy Radcliffe thing from Wealthfront puts out this 150 companies a year that they term by their metrics are high growth and a great place to grow your career, because of all the opportunities that happen when a company is growing and needs people to step up into bigger roles, and you move up the ladder more rapidly as the company itself grows. But that's happening at an industry level for us. And so it makes it crazy today to jump into Bitcoin, to quit your cubicle job where you have stability and more security. But if this industry grows into a fraction of what we think it will be, then people who build their career as early entrants into that industry will become the senior executives 10 years down the road. And that is the fork in the road for a lot of people right now.
Do you want to be an Excel jockey or an executive? The choice
and
is
not even
yours.
Maybe really quickly, I'd counter the risk. I mean, sure, risk overall industry wise, we have to temper our expectations and our excitement that we all have here, and just say that, even though we know where this is heading. But the point to make is that you don't have to work for a 3-person, pre-revenue Bitcoin startup. There are already larger organizations today, whether it's the public miners or even the Rivers, the BitGos of the world, companies that are Bitcoin focused, but obviously have more robust operations, right? There are companies of all shapes and sizes at which you can find a home and still accomplish that mission of contributing to Bitcoin broadly.
We're going to win. We're gonna win. Gentlemen, I'm 15 minutes late to a call. I gotta jump. This has been great.
Thank you, guys.
We didn't even mention.
Pleasure.
I feel well, Andy. Thank you for coming, but it'd be remiss of us to say, like, obviously Michael's not here. He's traveling for his Thanksgiving holiday. He was missed. This is great. This is a great motley crew we got here.
How long do you think it took people to realize that I wasn't Michael?
I don't think he can grow a mustache like that, so it probably happened immediately.
There's no replacing Michael. We miss him.
Yeah.
Thanks for coming on, Andy.
Thank you, guys. That was great.
Thank you all for putting up with my road dog voice. Cam and I road dogged it this week. Didn't get back into my bed until like 12:30 last night. The kids jumped to bed at 5:30, so that's what I'm doing.
The thing to predict, man, Marty.
You got to road dog it. You got to road dog it.
It's the morning part that'll kill you. 12:30, that's okay if you can sleep in, but you can't sleep in. That's tough.
Yeah.
Nope.
Things we do for Bitcoin, for our children, for a better world. That's why we're here. This is the last trade. We'll be back next week.